Stop before you put a single rupee into stocks or mutual funds. You need to hear this. So many people get excited, they pick a hot stock or a popular mutual fund they heard about and jump in way too quickly, only to watch their money go down. They all make the same predictable mistake because they skip one crucial phase. But what if you could bypass all of that? In this video, I am going to give you the pre-flight checklist you must complete before you start investing. Following these steps will save you from making costly errors and set you up for long-term success. Let's get into it. The number one reason beginners lose money is that they start at the finish line. They obsess over what to buy, which stock, which fund, without ever figuring out why they are investing in the first place. Investing isn't about chasing quick profits or blindly following tips, it's about using money as a tool to build the life you want. Without a clear plan, you are just gambling. And when the market inevitably drops, which it will, panic is what sets in. You sell at the worst possible time because you never had a real reason to hold on. The secret isn't finding some magic stock or fund, it's building a plan that makes you tough enough to ignore the market's day to day noise. So, before you even think about opening an investment account, you have got to tackle these three steps. This is the boring work that actually builds wealth. First is define your mission. What is this money for? Seriously, write it down. Is it for house down payment in 5 years or is it for retirement in 30 years? Your answer changes everything. Short term goals need safer investments, while long term goals give you the time to take on more risk for higher potential returns. And a huge part of this mission is securing your foundation. You must have an emergency fund with 3 to 6 months of living expenses saved in cash before you invest. The key is to have a buffer. This fund is your shield. It stops you from having to sell your investments at a loss when life throws you a surprise. Second up is know your personal risk tolerance. This is all about understanding how you will react when things go south. Generally, the longer your time horizon, the more risk you can comfortably take. If you are in your 20s or 30s investing for retirement, your portfolio can lean heavily into equity mutual funds. If you are getting close to retirement, you will want more stability from bonds. Don't just copy someone else's strategy, build one that lets you sleep at the night. Third up is the beginner's blueprint. Forget trying to find the next big thing. For 99% of beginners, the answer is an index fund or flexi cap funds, often in the form of mutual funds or an ETF. Think about a Nifty 50 index fund. With a single purchase, you own tiny piece of the 50 largest companies in India. This gives you instant diversification which protects you if one or two companies perform poorly. You are not trying to beat the market, you are just matching its performance over the long term. And that's how the real wealth is built. Now for the most powerful step and the one most people ignore, automate your investments. This is the secret to taking your emotions out of the equations. Set up automatic transfer from your bank account to investment account every single month, whether the market is up or down. This strategy is called Rupee-cost averaging. When the prices are high, your fixed rupee amount buys fewer shares. When the prices are low, the same amount buys more. Over time, this can lower your average cost per share and smooths out the bumps in the road. It's important to know this strategy doesn't guarantee profit or protect you from losses in a declining market, but it does enforce the discipline required. Research has shown again and again that time in the market is far more important than timing in the market. Trying to perfectly predict the market's ups and downs is a losing game for nearly everyone. Consistent automated investing is the most reliable path to building wealth. So let's recap the game plan. Stop trying to pick individual winning stocks. Instead, focus on the things you can actually control. 1. Define your financial goals and your timeline. 2. Understand how much risk you are truly comfortable with. 3. Start with simple index or flexi cap funds to get instant diversification. And 4th, automate your investments every single month to build discipline and stay consistent. Investing doesn't have to be complicated or scary. By building this simple plan before you start, you protect yourself from the emotional mistake that destroy most beginners and build a foundation for lifelong financial success. If you want to learn more, make sure you subscribe for more straightforward investing videos. Thanks for watching.